Today, I'll be looking at a couple aged 61 and 62 with roughly $2 million who still face significant retirement challenges. Over my years working with pre-retirees in similar situations, I've identified the common missteps that can undermine even substantial retirement savings. If you're new to the channel, hi, I'm Julia, certified financial planner, and that's exactly why I'm making this video today, to show you where this couple went wrong despite their impressive savings and what risks they need to address before retiring. So let's get into it. Meet Paul and Lynn Price, Florida residents who are 62 and 61 respectively. They just retired with roughly $2 million in retirement savings that they accumulated through consistent contributions to Paul's 401k and their brokerage account. They followed conventional retirement advice throughout their careers, right? Maxing out Paul's 401k and avoiding major financial mistakes. Yet now as retirement approaches, they've begun questioning whether they've overlooked important planning steps. Despite reaching what many would consider a substantial nest egg, they worry they may have missed crucial strategies that could improve their retirement security. Without professional guidance, they can't identify potential blind spots in their otherwise successful financial journey. So instead of feeling confident about their retirement readiness, they're experiencing growing anxiety around unknown risks and missed opportunities. What should be pride in, their ability to save and their success, that's been replaced by uncertainty about whether they've made mistakes that could jeopardize their retirement. They spend time researching potential issues, but can't determine which risks actually apply to their specific situation or how to address them effectively. They've never worked with a financial advisor, but they know they need someone to double-check their strategy. They came to me 6 months after their retirement to see if their current strategy is sustainable. We're going to look at it from 3 different angles: asset allocation, Social Security maximization, and withdrawal strategy. But first, let's look at their situation in more detail. Paul is 62 and Lynn is 61, and we have them both living to age 95. They have 2 kids, Michael and Stacy. Their net worth is pretty simple: a joint high-yield savings account worth $80,000, a joint brokerage account worth roughly $675,000, and Paul's 401k worth just over $1.4 million. And they have their primary residence worth $900,000, and that's fully paid off. This means they have roughly $2 million in investable assets, which are the assets that actually drive cash flow in retirement. Their only source of guaranteed income is Social Security, and we can see here that Paul will receive $42,300 per year, and Lynn will receive $32,400, both at age 67. We're going to experiment with filing dates in just a bit. So again, they want to be able to spend $120,000 per year to Paul's age 80, where their spending will naturally reduce to $75,000 in today's dollars. These expenses will inflate at 3% per year, and the software will also build in federal tax since they live in Florida. They don't have life or long-term care insurance. Okay, now let's run a few Monte Carlo analysis to determine how they'll fare using their current strategy. A Monte Carlo analysis is the best way to test the success of a financial plan. Simply put, the computer takes 1,000 different stock market scenarios between now and Paul and Lynn's life expectancies. A third of those scenarios use above average stock market returns, a third use average market returns, and the final third uses below average market returns. The computer then takes your baseline of information and runs it against all 1,000 of these stock market outcomes, giving us a percentage of likelihood that you will make it to your life expectancy without running out of money. We're looking for a score of 80% or higher. But before we do this, we need to run an analysis on their current investments to see what they stand to lose in a major bear market, because I'm going to use that scenario as a stress test to run in the Monte Carlo analysis. Okay, here we are in Riskalyze, and this is software that can quantify how much risk a client is taking so that we can see how vulnerable they are to the sequence of returns risk. Essentially, we want to make sure that they can withstand a major bear market at the beginning of their retirement so that they don't run out of money in their 80s. Riskalyze scores portfolios from 1 to 100, 1 being cash, CDs, treasuries, basically investments that can't lose value. The S&P 500 itself is a 73 out of 100, and Bitcoin, or a more volatile individual stock, is 100. We can see the scores here for their two investment accounts, a 64 for the 401k and a 78 for the joint trust. So pretty aggressive. The overall portfolio scores a 68 out of 100 and is made up of 66% stock, 31% bonds, and 2% cash. The average annual return over a 10-year time frame is 6.99%. The annual dividend is 3.87%, and the expense ratio is high at 62 basis points. The risk-adjusted return score is represented here by the risk-alized GPA. It's average at 3.7 out of 4.3. We can see that their portfolio can go down by 15% or up by 22% in any 6-month period. Ideally, it would be closer to a 2-to-1 ratio. Now it's time to stress test their portfolio to see how they perform in good and bad markets. I'm really just focused on a financial crisis replay, which was from October of 2007 to March of 2009, when the market lost 53.1% of its value. If this happened again, the prices would lose 45.9% or $967,000. Now, let's run a Monte Carlo to see how they do reaching their goals with this bear market occurring next year. Remember, the score is based on all of the basic information we just reviewed about them. Okay, we can see here that if they both live to age 95, their probability of success is just 73%, which isn't terrible, but it's not 80%, right? In order to get to 80%, which we prefer, they would need to reduce their annual spending from $120,000 per year to $116,000 per year, or by $334 per month. If they need long-term care at $8,000 between the ages of 85 and 88, indexed at 3% for inflation, their chances of success fall to just 42%, meaning that they would have to reduce spending by $25,000 per year, or a whopping $2,083 per month in order to self-insure. The thought of cutting spending by these amounts is unsettling, as they're trying their best to enjoy their lives without overspending already. So clearly there is a huge disconnect in their current asset allocation. It's just too aggressive, and the risk-adjusted return isn't there. And that means that they're taking too much risk for too little return. So to help them fix this problem, let's optimize their asset allocation. As a refresher, we always bucket or segment our clients' portfolios upon retirement. We make sure that they have anywhere from 3 to 5 years of expenses in fixed investments. So think high-yield money markets, CDs, individual treasuries, multi-year guarantee annuities, and the like. This is the green bucket. This ensures that they won't be forced to sell in a down market to pay for their lifestyle. You then invest 3 to 10 years in a balanced manner, the yellow bucket, so think 50% stock, 50% fixed, and the remainder, or the red bucket, can be invested aggressively in all stock, since this is money that you won't need for at least 10 years. Now, there are some advisors who believe you should replenish the green and yellow buckets every few years, and while I'm not vehemently opposed to this, I'm also not convinced that it's necessary. A market crash, meaning a lasting downturn, only occurs every 10 or so years. And the damage done from a market crash 10 years into retirement isn't nearly as bad as one that happens immediately upon retirement. So our vulnerability to these events gradually decreases over time, which is why if you're an aggressive investor, you don't need to fully replenish your green and yellow buckets after your first 5 to 7 years of retirement. Okay, back to Paul and Lynn. We can see here in their cash flow report that they'll need about $600,000 over the first 5 years of retirement. So we need to fix that. We're going to primarily do that in the brokerage account using a high-yield money market fund and an ultra short-term bond fund. We're also going to fix 6% of the blended portfolio for growth and income within their IRA. So this is a total of $600,000. Then we invest for both income and growth to fill the yellow and red buckets. When we do this, we see that their risk-adjusted return score raises all the way to a 4.3 out of 4.3, and that spread that we were talking about earlier is much closer to a 2-to-1 ratio. The overall portfolio has 64% stock, 6% bonds, 25% high-yield money market, and the remainder in income funds. Their average annual return is 8.66% per year, which is 2% higher than their current portfolio. And their dividend is also slightly higher at 3.95% per year. Their expense ratio is cut by more than half to 19 bips per year. Plus, if another great recession occurred, instead of losing $967,000, they would lose $649,000. So this is a win across the board. Now let's see how it helps them in the stress tests. We can see that if Paul and Lynn live to age 95 with their new portfolio, their chances of success increase to 91%. So this means that they can actually increase their annual spending from $120,000 per year to $129,000 per year. This is very comforting for them because they were already feeling like they were as lean as they could get. However, if they both need long-term care from ages 85 to 88, their chances will fall to 69%. So this means that they may need to reduce spending to be able to self-insure without selling their home, right? Especially if we can't improve the chances enough through Social Security or tax planning. Here we can see that they would need to reduce their spending by $9,000 per year or $750 per month. All right, so let's see if we can refine their strategy around Social Security. They said they were thinking about pulling Paul's now and Lynn's next year at 62 because neither one of them has a pension. On their Social Security maximization report, we can see their current ages as well as their life expectancy. Paul's average life expectancy, which is based on his current age of 62, is 81 years old, and Lynn's is 83 and 10 months old. So this report is going to tell us the best time to file for each of their benefits if they live to these ages. We can see their primary insurance amounts here, which we reviewed earlier, of $3,525 for Paul and $2,700 for Lynn. Their optimized filing strategy is for Lynn to pull her benefit at age 66 for $2,520 per month, and for Paul to claim his own benefit at age 69 and 8 months for $4,277 per month. If we compare this to them pulling right away as they planned, Paul would get $2,512 per month and Lynn would get $1,890 per month. So we know that if they live to 81 and 83 and 10 months respectively, they'll receive over $94,000 less if they take their benefit right away. But let's see if it affects how much they can spend in retirement in just a minute. Back in the Monte Carlo Center, we can see that if they pull their benefits right away, their Monte Carlo chances of success go from 90% to 88%. And this means they won't have quite the same flexibility in spending. If they max their Social Security per the report, interestingly, their Monte Carlo is the same as them both pulling at age 67, but they can spend an extra $1,000 per year. If they follow the split strategy where Lynn pulls at 62 and Paul at 70, chances of success reduce again. If they follow the mini split strategy where Lynn pulls at 62 and Paul at 67, we get a great chance of success, but it doesn't allow for quite as much spending flexibility. This confirms that pulling their Social Security, either according to the maximization report or the mini split, as it's a very small difference, are the best strategies. Now, before we get to tax planning, let's quickly look at their income guardrails using the modern guardrail approach rather than a Monte Carlo approach. I like to use both in our analysis because they're analyzing the same information in the two best ways to evaluate a financial plan. You'll notice that the amount they can spend per month here is higher than the Monte Carlo at 80%, and that's because it's not testing for a bear market in 2026. However, this does provide us with guardrails so that we can adjust our spending based on portfolio performance. The amount that anyone can spend in retirement is ultimately dependent on the value of their portfolio. So because the stock market isn't linear, the spending doesn't have to be linear either. We all know we need to adjust our spending based on our portfolio, but we don't know exactly how to do this. And this is where this software comes in. Here we can see that if we have a few really great years in the stock market and their portfolio grows to almost $2.7 million, they can spend $14,693 net per month. Now, on the flip side, if we endure a market crash, they will need to reduce their spending to $11,305 net per month, which is right around the same figure as the Monte Carlo test from earlier. It's slightly higher because this software does have them living to age 95 instead of age 100. Okay, lastly, let's look at tax and their different distribution strategies to see how they should be withdrawing income from their portfolio to minimize their lifetime tax liability. First, let's look at all of the strategies one could take when distributing their portfolio for income. I want to focus on the second one as it's the most common among advisors and do-it-yourselfers, and this is called conventional wisdom, or taxable, tax-deferred, and tax-free. This is a widely held belief that upon retirement, you should pull from your after-tax assets first, meaning your savings and taxable brokerage accounts, then your pre-tax accounts or your traditional IRAs and 401ks, And lastly, your Roth IRAs. And while we normally agree that Roth accounts should be pulled after your brokerage and pre-tax accounts, if you have a decent amount of Roth monies, the strategy normally is not ideal. Remember that the prices don't have any Roth accounts, so if they don't want to do any Roth conversions, we want to know if they should pull their income from their brokerage accounts first or their pre-tax IRAs. Their original plan was to do just that, pull from their brokerage and wait to pull from the IRA once Paul turns 75 for required minimum distributions. We see that if they pull from their taxable accounts first, or conventional wisdom, that their average lifetime tax rate is 13.04%, and they'll pay total estimated lifetime taxes of $854,712. However, if they pull from their tax-deferred first, or their IRAs, their average lifetime tax rate is slightly lower at 12.68%, and they end up spending about $75,000 less in total lifetime taxes. When we take a closer look at the comparison and look at future values, which I believe are more accurate because inflation is real, we can see that by pulling their income from their IRAs first, they can save over $275,000 in lifetime taxes, and because of that, can spend more, and their net legacy increases substantially. Before we can decide that this is the best non-Roth strategy, we need to see when this decision starts to pay off from a tax-paid perspective. Remember that when you're pulling from pre-tax first, your tax liability will be higher up front. So in this chart, we can see that the break-even age isn't until ages 90 and 89 under current tax law. This is just too old for them to consider this strategy, so if they don't do any Roth conversions, they will plan to use conventional wisdom. But what about Roth conversions? If we scroll down here, we can see the different Roth conversion strategies by tax bracket and by IRMA bracket. IRMA is the Medicare income-related penalty that can significantly increase the cost of healthcare in retirement. So it's a very important threshold for Roth conversions. I'd like to see how converting up to the first Medicare IRMA bracket to avoid any Medicare penalty would work for them over the next 5 years, so from years 2025 through 2029. On the surface, we can see that it would save them an average lifetime tax rate of 3% per year and over $550,000 in taxes over their lifetime. Their break-even age here is 82 and 81. Paul and Lynn believe that future tax rates will increase, and they want to have a tax-free bucket of money growing in some capacity. So they plan to follow this strategy for the next 5 years. In our practice, we do our best to convert clients' money during market downturns, even if they're short-lived, as that's the best way to make the most of a market downturn. Convert when it's low so that the monies can grow tax-free from that point on. So let's see if that helps them in terms of self-insuring for long-term care. Back in the Monte Carlo Center, where we run the scenario where they both need care between 85 and 88, and they do the 5-year Roth strategy, we see that their chances of success increase from 71% to 77%. So now, to get to an 80% chance of success, they just need to reduce their living expenses by $2,000 per year or $167 per month. If I were the prices, 77% would be high enough for me to keep spending that $120,000 a year. They can feel comfortable knowing that they won't burden their kids if they need long-term care. They don't really have to sell their house, right? Because they make it work using this. Now you've seen how this couple at 61 and 62 with $2 million saved faced unexpected retirement challenges that we fixed by optimizing their asset allocation, their Social Security strategy, and their tax strategy. You can learn from their experience to better protect your own financial future. And if you're looking for more help, I've put together a comprehensive training video that dives even deeper into optimizing your retirement plan, so just click the link below to watch it. See you next time.